Well, very good afternoon, students. Before I take you up through the content of today's discussion, I would like to introduce myself. I started my teaching in the year 1996. For 4 consecutive years, I taught the students in Delhi. Later to that, I got into corporate sector wherein I worked for 23 years. My last stretch of working was in education sector wherein I was interacting with the students on live platforms starting from Kashmir down south, Kanyakumari, and northeastern states down south, west, which is Maharashtra till Mumbai, all across lakhs of students whom I interacted. After the stretch of working in education sector, I thought of starting up and helping students precisely who are in commerce stream. So I started up this AKS Commerce Academy, where I welcome you all on this particular platform. So I would like to take up the most important chapter because the whole accounting begins precisely on journal. So I'll give you a brief understanding about journal, how what are the principles to be incorporated before you take up journal. Also, those who have not yet understood anything prior to this, they can also understand this. I would expect all of you pay attention to the subsequent discussions that we are going to make today. So in this particular chapter, the learning objective which you will be having is meaning of journal first, second journalizing, the process of journal is journalizing, characteristics, the quality, the nature, the advantages of journal, why do we do that and what are the advantages that we get by preparing a journal, the limitations, every concept has some limitations, so does accounting as well, journal as well. So I'll give you some limitations, then steps in journalizing. What are the step one, two, three, four? Simple and compound journal entries, which you will understand. The complex entries as well, alongside the simple ones. Discount and rebate, which are very commonly used terms. The extent of understanding which is required with regard to passing a journal entry. That also I'll help you understand this. Difference between trade discount, rebate, cash discount. So this also you'll be learning how you are going to make use of these learning while passing a journal entry. And opening journal entry, the when a particular business starts up, what are the opening journal entries and how these entries are to be passed. So I have divided this whole chapter into two parts. The first part we will take it up today, and the next part I'll take up the next class. So let us first of all understand what is the meaning of journal. This to a larger extent covers everything. It's a book of primary entry or a book of original entry in which transactions are first recorded in chronological order. Let's break it down now. So it's a primary entry where, so far we have not yet entered in any book. We have learned the principles and related theory based on accounting, which is required in order to pass journal entry. But this is the primary entry. When a business transaction takes place, then it is required to be entered in the books of account, and where it gets entered, the way it gets entered, it is journal. So that is why primary entry or a book of original entry in which transactions are first recorded in the chronological order. The chronological order means it is sequentially, as and when transactions are happening, accordingly it gets recorded. From the accounting vouchers, we have seen what are accounting vouchers, which are prepared by accountant basis the documents or evidences. They prepare accounting voucher wherein categorically it is mentioned which account is to be debited, which is to be credited, and then it is signed by the senior accountant as well, and then subsequently it is entered in the books of account that we have seen in the previous class. That is prepared on the basis of source documents like cash memo, invoices. So basis that the accounting vouchers are prepared, and basis the accounting voucher in a chronological order or as and when transactions are happening, entries are made in the primary book or original entry where in the primary entry or book of original entry, what we call it, that is cash memo, invoices, purchase bills, etc. So I hope the meaning is clear with regard to what is that we are going to learn. First of all, how entries are made, what is this chronological order, accounting vouchers we have already studied, source documents we have already seen. Let's see now a second part of this. Transactions can be recorded in one journal. Now this is important. If the scale of operation is less, small, then one journal can suffice the recording of the transactions. But if the scale of operation is big, having various departments in a firm or an organization, then specific nature of transaction can be originally recorded in its original book, specifically meant for that kind of transaction, that nature of transaction. We call it as subsidiary books. So I hope you have understood. One journal suffices the requirement of a small firm where there are limited number of transactions, but as the scale increases, that does not suffice because it is going to be voluminous. So specific nature of transaction, specific journal is kept, and that is called subsidiary books. For example, purchase book, sales book, purchase return, sales return, bills receivable, bills payable. So these are the books which are separately kept if the volume of transaction specific to these books or this nature happens to be more in a firm, there is always advisable to go with a subsidiary books alongside journal, or what we call it as journal proper. Now let's understand the definition. Meaning, to a certain extent we have understood. It defines, as we have understood the meaning, in a similar way the definition also gives us the same understanding. What it says, it's a journal is a chronological record, means as and when it is happening, accordingly sequentially it is written, of financial transactions of a business. All the financial transactions as and when they are happening as per the principles of recording, we record in the books of account, which is nothing but the journal. Now let's go ahead and this particular definition is given by Mr. M.J. Killer. Now, having understood the meaning and definition, I'll help you understand the terms or expressions used for journal. So what are the terms which are used? So book of original entry. I hope you have understood original entry, where in journal or subsidiary books entries are made. Journal entry, once the books are maintained, then there is entry done in specific books if all the subsidiary books are maintained, if not only in journal. Journalizing, the process of entering in the books of original entry, is called journalizing. So this is talking about here, it talks about process. And then comes posting. Now there is a ledger, which we will understand it further more detail, but there is posting, means from journal the next step is preparation of ledger account. So every specific account is going to be prepared, and each account will give us the meaning of the total balance that particular account has once we close it. The process of taking up the reference of journal entry and putting them into the specific ledger account is called ledger posting. So this also we will learn. Now let us understand the functions of journal. Now this is very important, that what it does, what are the areas of its working. So it is maintaining the chronological record of transaction. This is again important, chronological record, not haywire record, sequential record of transaction. Analysis, the analyzing the transaction, whether it is to be debited or credited, this requires to be understood considering the nature of transaction that has happened and the accounts which gets involved in that particular transaction. Accordingly, debit and credit is decided. Basis of ledger posting. Now accounting journal stands as a basis for ledger posting or posting into relevant account. So for example, if sales is done, then account which is wherein all the sales are recorded. If there is a sales book maintained separately, then it is going to be entered in sales book. Otherwise, it will be entered in journal. So basis of ledger posting happens to be the journal. From the journal, we post it to the ledger in the relevant account which we have considered while entering in journal. The accounts which are involved gets created in ledger, and accordingly the posting is done. I hope the functions of journal is clear. What it does, we have understood it with these three examples or 3 points. Now let us understand a little more with regard to the characteristics or features of journal. Now, what are these characteristics? It is day-to-day transactions are recorded. So every single business transaction that gets executed in a firm or an organization gets recorded in the business in journal. So it is day to day, transaction to transaction gets recorded. It is the book of original entry. So what does it mean? Original entry, as we have seen prior to this, nowhere it has been recorded. It is where primarily recorded. So it is book of original entry. It records both aspects of transaction. So as we have seen, it is debit as well as credit. Both the aspects of transaction gets recorded in this. Narration of every entry. Narration is nothing but briefing about the transaction. Supposingly, if one account is debited, other account is credited. Now, for what transaction this particular entry is passed in journal, for which a brief description is written, what we call it as narration. Then it shows a complete details of transaction in one entry. Complete details of transaction means, so if a particular transaction which involves two accounts, then two accounts gets entered. If it involves three accounts, if it is a composite entry, then or combined entry, then three account gets involved. So in one single entry, the nature of as per the nature of transaction, the accounts involved are identified, and then subsequently it is entered in the books of account, which is journal. Journalizing is the process of recording a transaction in the journal. So as we have already seen, journalizing is nothing but it's a process of recording. The whole work that we do to record is journalizing. So it's a process of recording transaction in the journal. Now let us see some advantages. Now these advantages, if you look at, you will understand. We have seen the characteristics, but there is corresponding advantages to it as well. What are they? Provides accounting data in chronological order. We have seen that is one advantage that journal provides us. Possibility of error is reduced. So when we are debiting as well as crediting in a proper way, so error possible, and there is a totaling as well. So the error possibility is reduced to a significant level. Explanation of the transaction. As I said, there is a narration given after every single entry is done, which briefs about the transaction. Therefore, we have an understanding by looking at a particular entry, what purpose for which this, or what is why we have passed this entry is briefed in the narration itself. Then ledger posting of transaction, it stands as a basis for ledger posting. Then comes the next one, locating errors in becomes easy if trial balance does not match. So next step after having prepared journal, there is ledger. From ledger we prepare trial balance. Anyhow, we will learn about trial balance later in the subsequent chapter. But for now, you understand that if the trial balance total does not match, then there must be some preceding error resulting into mismatch of trial balance, and that can be understood and located as well. So these are the 5 advantages that journal has, which we have understood. By and large, there is meaning, characteristics and definition also we have seen, and the advantages that it has with regard to the business that we have understood. Let us also understand some limitations. Now this is also important for you to understand that what it where it does not do to the fullest, not suitable for large volume of transaction. Only by entering in journal, it does not suffice the whole requirement with respect to analysis, finding out the balances of a particular account. It does not give. So when it is large volume of transactions, perhaps we it does not work to the extent we expect journals to work for us. Cash balance is not revealed. As I said, since balances are not there, only the entries are made. Therefore, we prepare a different cash book in order to get the cash balance. So this is also a limitation of journal, not or substitute for ledger. Anyhow, ledger is required to be prepared. So it is not a substitute because ledger reveals the balances. Journal does not reveal the balance. It only shows the entries that of the business transaction that has happened during the day, during the month, or over a period of time. So having understood the limitations, let us now understand the format of journal. So what is the format? Now this is a simple format which is appearing here. So date, on a particular date when we are entering, say for example, let's say 1st January 25. Now particulars, here we write the items to be debited or account to be debited and account to be credited. So here we will write, let's say Ram account, we write here debit, okay, denoted by dr. Then we do it this way, dot 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 to cash. If we are making him cash, we will write cash account. Okay, now ledger folio, and then there is narration given here that being cash paid to Ram for purchases done. All right, so a brief narration is given. Ledger folio, which page of ledger this particular transaction is posted, is entered here. So Ram account is which page of ledger where we are entering this is posted there. Then so we will not be entering it here. It is just for reference. Debit amount. Now Ram account is debited, let us say 10,000. So we'll write here 10,000, and cash is credited by 10,000. So we'll write here 10,000. With this imaginary example, I hope you have understood now. So in this particular format, how the entries are made. Now let us see the rules of debit and credit. So we have already seen this at length while understanding the rules of debit and credit chapter itself, but for give you a briefing and recap of it, the whole thing that we discussed there. So rule says based on traditional classification. So we have two classifications of a particular account. We can go with traditional classification or modern classification. Some differences are there. So more traditional classification, as per traditional classification, the accounts are classified into three broader categories. One is personal account, then second real account, and third is nominal account. So in personal account, debit and credit, which is to be debited, which is to be credited. So the rule says that debit the receiver and credit the giver. This is personal account rule. Very simple. Debit the receiver. The person who is receiving is to be debited. The person who is giving is to be credited. Personal account means name is important because that individual is important with regard to debit or credit to be done. And there is a rule defined. If the account happens to be personal account, then debit the receiver and credit the giver. Second is real account. What comes in debit, what comes in credit, what goes out. So real account, precisely the assets account, which are receivable for the company or the firm, or which is already possessed there, which is there like furniture, building, plant, machinery. So these are all real account. Debit what comes in. If there is any new furniture coming in or bought in for the business, so debit is to be done. Debit what comes in. If anything is going out, maybe cash is going out, which happens to be real account. So if it is going out, so we need to credit it. Simple. And third is nominal account, which is related to expenses and income. So all expenses and income, expenses and losses are to be debited. All income and gains are to be credited. Now, the modern classification, a further more refined classification, which brings down the ambiguity to the least level, and it becomes easier for someone to classify the account into 5 category, and accordingly entries are made. Very simple and simplified way of understanding. Assets, if a particular account which happens to be asset, then debit if there is increase, and credit if there is decrease. Liability, if it is debit, if it has to be if it gets decreased, then we need to debit it. If it gets increased, we need to credit it because of a particular transaction. Capital, if it increases, there will be credit. If it decreases, there will be debit. Revenue, earning, if it increases, we need to credit it. If it decreases, we need to debit it. And expenses, if it increases, we need to debit it, and if it decreases, we need to credit it. So this is how we prepare, we understand modern classification of accounts as per 5 categories, 5 heads that we have seen: assets, liabilities, capital, revenue, expenses, and traditional classification. Whatever way you apply, the outcome is going to be the same. The entries are going to be what it is done for traditional classification. The same entry will happen for modern classification. So entry, there is no differentiation, but understanding an account, whether it is traditional classification, what category it falls, or modern classification, what category it falls, may differ, but the entries are going to be the same. Whatever principle or whatever classification you follow, resultant is going to be the same. Let us understand and comparatively study this. The sold goods to Ram. So there, which are the first thing we need to ask is which are the two accounts gets involved here. So one is sales and second one is Ram. Now sales is in case of a traditional classification, traditional and modern. So in case of traditional classification, so sales is real, personal, nominal. So it is revenue related to income and expenses. So it is a nominal. And what about as per modern classification, it is revenue. Okay. Now second, Ram, as per traditional classification, it is personal, and as per modern classification, debtor. So asset, because when we are selling on credit to Ram, then Ram becomes a debtor. Debtor is nothing but, debtor means person from whom we have to receive money. Money is receivable from Ram, so Ram becomes debtor. So it is debtor. All right. Now the second thing we need to ask, which is to be debited and which is to be credited. So as per traditional rule, now let us say there is debit credit to be done. So this is debit, credit, and modern also debit and credit. Okay. So as per this sales account, traditional nominal rule says that debit all losses and expenses, credit all income and gain. Therefore, sales account is an income. It is bringing revenue to the firm. So it is an income. Income requires to be credited. So sales is required to be credited. And Ram, and as per modern classification, revenue. So there is an increase in revenue. So it requires to be credited. Alright. Ram being personal, what is the rule? Debit debit the receiver and credit the giver. So in this, when we are selling it to Ram, the personal account says that debit the receiver, credit the giver. In our scenario, when we are selling goods to Ram, Ram is the receiver. So we need to debit Ram as per traditional rule, and as per modern rule, what it says, when there is Ram is a debtor, so there is increase in asset because we are selling on credit. So receivable is increasing. When receivable is increasing, it is increase in asset. So debit Ram. So as per the rule of traditional or modern classification, term may differ, but the entry remains the same. So you don't need to think it that if I'm classifying it as modern, so my journal entry is going to be different. If I am classifying it as traditional, the journal entry is going to be different. No, it is going to be the same. Both the scenario we have seen, the journal entry remain the same, but the classification as per modern differs vis-a-vis as per traditional. I hope this is understood. Let us now see salary paid rupees 5,000. So when we are paying salary, so what are the two accounts get involved. So one is salary, second one is cash. So salary is as per traditional classification as an expense. So debit all losses and expenses. So it is nominal and cash is real. I hope this is clear. So in case of salary, nominal account and cash is real account. Modern classification, when we look at what is this, salary is an expense and cash is an asset. Now what is happening here? So salary, there is an increase in expense, so this is increasing and this is decreasing. Expense is increasing, cash is decreasing. So the what is the entry finally we are going to do? Salary account debit to cash. So cash is going out, so we will credit cash, and salary is an expense, we will debit, which is supported by both the rules, be it traditional classification or modern classification. I hope you have understood. Now, after having done this, what we do here, so totaling. So once the journal entries are made, there may be a scenario that the whole page. So we have seen the format of journal entry. So this is the format, debit, credit. Okay. So after the page gets filled, this is the final page. So when the page gets filled, we carry the balance to the next page. This is called casting or totaling. So let's say total, which we have here. So total, this is January month total. Okay. So total carry forward. If the amount happens to be say 10,000, both the places it is going to be. Now there is a February month journal when we are preparing. So how it is going to be there? In the same way. Let's see here, particular date, everything is written, debit, credit. So we will write here total balance brought forward. All right. So this is balance brought forward 10,000, 10,000, and then February month's entries are going to be done accordingly. So I hope this is understood. This process is called casting or totaling and then carrying forward. Now recording in journal. Let us see how it is done. Examples to understand the reasons for debit and credit. We will take up certain examples and understand debit and credit, why it is debit and credit. Though to a certain extent we have seen in the previous two examples, I will take up few more as well for you to have a better understanding on this. So Ram started business and introduced capital of rupees 1 lakh. Which are the two accounts which are involved? So there is capital, which is 1 lakh, and then there is cash. Okay, so there are two things which has come up. One is cash, another one is capital. So cash also 1 lakh. So what is the entry that we are supposed to do? So the classification says that capital is a liability for the firm to the businessman. So the entry which is supposed to pass is, it is a liability, so there is increase in liability. So what entry we will pass? Cash account, business is receiving cash from the businessman and to capital. So this is debit and this is credit. So we have understood using the logic, be it traditional or modern. Capital is a personal account, so there is debit the receiver, credit. In the personal account the rule says that debit the receiver, credit the giver. And capital, when the cash is coming in the business, so there is increase in asset, so there is cash debited and capital gets credited. So very simple. You have to see it from business perspective, because business and businessman are two different entity. Therefore, recording is to be done as per this. Now, purchase furniture for office from Raj Furniture for rupees 10,000, paid by check or in cash. So when we are the two items or the accounts are to be identified here. So one is purchases furniture. So since it is a purchase of furniture, so we'll write furniture. I'll just erase. Now take up here furniture debit, furniture, and then second account is cash or check, means bank. Furniture account debit 10,000 and cash or check 10,000. So we have understood these two, and furniture or cash. The furniture account, furniture is coming in the business, so we will debit furniture and we will credit cash. In case payment is made by cash, in case payment is made by check, we will credit bank. Now comes the third one, purchase goods for 50,000 against check. So when we are purchasing goods, the two items to be identified, one is purchase and second one is check, bank. So we'll enter bank. Purchases means since goods are coming in the business, so we will debit it, and cash or bank is going out of the business, so we will credit this. So there will be 50,000 here and debit 50,000. I hope this is clear. Then comes the next one, sold goods for 25,000 against check. So we are receiving the check and presuming that the same check is deposited in the bank on the same day. So the entry is, one is bank and second one is sales, because we are selling goods. So goods are going out of the business. So bank is debit 25,000 and sales is credit 25,000. I hope this is understood. The two accounts which involved, apply the rule and accordingly debit and credit is to be done. Paid a salary of rupees how much? 50,000 for the month of December by a check. So the two accounts, one is salary and second one is bank. So debit salary because it is an expense, increase in expense. So debit salary by 50,000 and credit bank by 50,000. Okay. Received 10,000 from Ajit, a debtor. So to whom we sold on credit, he paid us back. So the account involved are cash when we received cash, and second one is Ajit because name is important. So he is to pay to us. So cash account 10,000 we have received and 10,000 credit, because when he bought goods on credit he was debited. So the entry we passed, Ajit debit to sales. Now there is a debit standing 10,000 rupees, and this debit, once we are crediting it, means his balance gets settled. So this is important to understand that there was a debit done. So we are crediting now for the cash we have received from Ajit, who happens to be a debtor for the firm. Now let us see, paid cash to Sujit, a creditor 5,000. So entry which I'm supposed to do is the two accounts, cash is paid and Sujit. So cash is going out of the business. So this is required to be credited. I rewrite it, credit. Okay. So this is to be credit and this is to be debit. The entry is required to be passed is this way, Sujit debit to cash. All right. Then we will take up, let's have a recap of what we discussed today. So by now, I hope you must have understood some preliminary level of understanding with regard to journal. So the learning objective which we started with, meaning of journal, journalizing, the process of doing journal is journalizing, the characteristics and advantages of journal. So what are the features that we have seen, the advantages, the benefits, what it provides. It gives us information in a chronological order, and some more advantages we have seen, limitations where it fails a bit, and when there are huge volumes or firm happens to be a big firm, in that scenario journal does not suffice alone, rather subsidiary books are to be prepared. Steps in journalizing, we have seen 7 examples, and prior to that as well 2 more. So all these may have briefly given you some understanding with regard to the journal. Now, simple and compound journal entries we will see in the next chapter, next class. Discount and rebate, difference between trade discount, rebate and cash discount, and opening journal entry. All these we will see in the next class. So for now, I thank you for listening to today's discussion. I would expect all the viewers to like, in case if you have liked the content, subscribe for the channel so that the next videos which I come up with, you happen to have access, immediate notification. Share the channel to the students of your class, be it in neighborhood, be it in school, and would expect you to mention your feedback in the comment, because your feedbacks are of great value to me personally. I happen to look at every one of them and revert to you if it requires an answer from me. I would also expect you to contact me for any query that you have. My WhatsApp number is given, email address is given. You can make a mention of anything that comes up in your mind if you'd like to inquire from me. So this video, as I told you in the beginning, how I came up with AKS Commerce Academy, with precise objective of helping students from content perspective understanding perspective so that they not only happen to do well in their examination, but any level of assessment subsequently, if they are going to face, because of their good understanding on concepts, they can work out even application based questions, because it does not suffice that you only know the concept, but to what an extent you have learned to apply them. That is the real objective of learning. I hope with this discussion you must have understood the concept, and to a certain extent the way we have learned to apply those concepts. So I once again thank you all for being in here, and would expect you to like, subscribe, mention feedback in comment, and in case if you have any query, please come back to me. Make a mention in WhatsApp or email. Thank you so very much. Wonderful talking to you. All the very best for your upcoming exams.